Hello everyone, welcome to the second of our ACCA F8 lecture recaps. This is a recap of the full course lectures available on our website. Also on the website, all of these mind maps are available to download for free, so it's mapitaccountancy.com. Moving into what we talked about, we were looking at the rules surrounding regulation of audit. So looking at the standards, the ICEs that we'd be using throughout this course. First of all, we need to recognise what IFAC is, the International Federation of Accountants. Now, these are members taken from all of the bodies, for example, ACCA, ACA, all will be represented. Now, IFAC will oversee the IAASB, the International Auditing and Assurance Standards Board. This is the body that sets the standards. How do they go about setting that standard? Well, they first of all identify new projects, so areas where new standards may need to be set. They set up a task force to look at that area. They then consult. They draft up a new proposal, which is given public exposure for 120 days. They make any amendments that are required. Then they get approval. So that's how the new standards are set. When it comes to national standards, each nation has a choice. What they can do is they can implement those ICEs, or they can modify them slightly if they wish to do so. They can set their own standards, but be aware that if you're in the EU, they have implemented the ICEs, so that's what will be used in that area. Thinking then about the law that applies to audit. Well, remember, not every company has to be audited. So in the UK, for example, large companies with a turnover in excess of 6.5 million must be audited. So they do require an audit. But for small companies less than that, they don't require an audit, but may choose to be audited for whatever reason. For example, the owners of the business don't manage it and they want to get some assurance that things are going correctly. So we looked at illustration 1 to see how this can be applied in the exam, and then we moved on to look at the auditor. So we talked a little bit about this in lecture 1. The duties of the auditor, remember, are to form that opinion that the financial statements present a true and fair view and are prepared in accordance with applicable reporting standards. So in accordance with applicable reporting standards. They also need to check, number 1, that proper returns have been made by the business, that the financial statements agree to the records, that proper accounting records have been kept, that information and explanations have been obtained, and that other reports in the accounts are consistent with the financial statements. For example, the director's report. Remember, all of those 5 things are reported by exception. They're not mentioned in the audit report unless there's a problem with them. So reported by exception, worthwhile learning those 5 things. Who can audit? Well, remember, this is a member of a recognised supervisory body like the ACCA. They also have to be allowed by that body to audit. So for example, in the ACCA, you have to have your auditing certificate. They can also be state authorised, and there are some people who are excluded by law. So for example, if you're an employee of the business, if you are a business partner or an officer of the company, you cannot audit that business. So make sure you recognise that. When it comes to appointment of the auditor, remember that the auditor is appointed by the shareholders. When we come to look at the audit committee will recommend the appointment, but the shareholders make the appointment. How long is it for? It'll be from AGM to AGM. If there's no AGM, well then they'll be reappointed annually. How do you remove the auditor? Well, it has to be by a majority of the shareholders at the AGM, or they can resign. If they resign, they'll issue that statement of circumstances that we talked about in the full course. Some of the rights of the auditor, well, when they resign, well, what they need to do is they need to circulate those circumstances. Remember, that statement needs to go out to tell everyone why they've resigned, or they can call an EGM to actually let people know why they resigned. During the audit then, they have various rights. They need to get all of the information and explanations. They have access to all of the books and records. They get notice of the AGM, so the auditor has to be given notice of the AGM, and they have the right to be heard at the AGM. Lastly, they can get all written resolutions. So all written resolutions of the company need to come to the auditor. So we looked at illustration 2 to see how this comes up in the exam. The auditor's responsibilities then we talked about. Well, remember, on resignation, they have to give prompt clearance to the new auditor. They have to say, right, this is why you may or may not take on this engagement. This is all the information you need. They also have to give that statement, very important, statement of circumstances. We've mentioned it twice already. On appointment, they also have responsibilities. They first of all need to get that clearance from the outgoing auditor. And they need to check that there are no reasons not to accept. And we'll look later on at what reasons there might be not to accept. So that brought us through to corporate governance. Key area here. The key concepts around corporate governance, remember, were that it's a system of business governance, that there are various codes which can be prescriptive, like in the US, or principles-based, like the UK. It's to enforce that system of business governance and to create stable investments for pension companies, etc. Really, it was a response to corporate failures such as WorldCom, Enron, all those big businesses that failed due to poor corporate governance. It's also an attempt to make sure that corporate reporting standards are upheld. So the sorts of things that corporate governance will cover, first of all, it'll cover the shareholders' interests. It'll cover the auditor to tell you how they should be acting. And it will cover the board, very important, because they control the business. So let's look at the principles. These are the principles in the UK or the combined code. The board of directors. The board of directors has to be effective. How can they be effective? Well, they need to set out the responsibilities for all of the directors. They also need to have regular meetings, so look for scenarios where that's not happening. They need to have a separate CEO and chairman so that there's not unfettered power for one person. They need to split the executive and non-executive directors. So remember, a non-executive director, a NED, is someone that gives an outside view. They don't work within the business, they just come in for the board meetings. So they're providing an outside view and they're providing expertise. It won't just be anyone, it'll be someone who has expertise in the business of the industry that they're in. So remember, there has to be half non-executive directors on a large company board or at least 2 non-executive directors in a small company. The board has to provide timely information. There has to be a formal, transparent nomination process. There has to be an induction process for the directors. There has to be a performance evaluation and their pay will be based on that performance evaluation. And they have to be re-elected regularly. Learn these. Look for scenarios where these aren't happening. Recommend them. Directors' remuneration. Remember, it has to be enough to retain the directors, but not excessive. It has to be performance related. And it has to be set by an independent committee. Finally, it has to be disclosed. So you can't keep it secret, it has to be disclosed. When it comes to accountability and audit, well, remember that the board has responsibility for internal controls. So management must identify risks and design and operate internal controls to meet those risks. There also has to be that risk-based approach, and there has to be an annual assessment of the internal controls and a board statement to say that they accept responsibility for those internal controls. Also, when it comes to audit, the board is supposed to set up an audit committee. So it's recommended that every business has an audit committee, and the board also has to make a balanced assessment of the performance of the business over each year. When it comes to shareholders, they need to make sure they maintain the rights of shareholders, and crucially, they need to value the input of shareholders, particularly institutional investors like pension funds, insurance companies, etc. So they need to keep them well informed and look at how they're dealing with those institutional investors. Remember, all of this needs to be disclosed in a report in the annual financial statements. So we looked at illustration 3. This will usually come up in a scenario where perhaps they're not doing any of these things, and you'll need to recognize that and recommend improvements. So that was our lecture 2. Make sure that you go and download the mind map to look at this and revise it for the exam.